Hello, property navigators. If you can find a property in an area that is sensitive to interest rates lowering, you can buy early and make a ton of money before everyone else. There's thousands of different suburbs and markets that will provide much higher returns than others as the interest rate lowers. It's fact. Today I'm going to show you how to find suburbs and markets that have different sensitivity to interest rate changes, so you can buy exactly where you need to be early. But before we get to the calculations, we have to run through and understand a few basics, starting with the bigger economic picture. Now, interest rates set the stage for virtually all borrowing in an economy. When our central bank, being the Reserve Bank of Australia, adjusts its benchmark rate, it ripples through the entire financial system. Mortgage rates typically move in tandem, which directly impacts how affordable it is, and I'll repeat, affordable it is for people to buy property in three main ways. Firstly, when central banks lower interest rates, this usually means an increased accessibility to debt, which means cheaper money borrowing for businesses and people. So the same person with the same income and savings can typically afford to spend more money on buying a property. Simply, the banks will lend them more money because money is cheaper to borrow. Secondly, investors may continue holding their property or properties because it costs much less for them to do so in servicing their debt. Their borrowing capacity may also increase due to the lower servicing levels, so they could buy more property. And thirdly, this access to cheaper debt helps businesses expand and grow, which supports job creation and higher paying jobs. This means buying property becomes more attainable for a wider range of buyers. Now, these attributes can come together and be very positive for some property markets, but certainly not all. Here's the key metrics you need to know to find the best suburbs that are interest rate sensitive. Let's start with the number one, the absolute holy grail metric of affordability. Now, this is the first place to start. Affordability is crucial because it dictates how many people in a given area can genuinely afford to purchase property. To understand this, we need to very quickly look at the graph that's now on screen. We can see that property prices and average Australian wages have been at a higher disparity since 1995 onwards. It shows the gap between what Aussies are generally earning compared to what they need to pay to buy a property. The gap has become huge. This graph shows that most people struggle to afford to buy a property in relation to their income. And this is why affordability as a metric matters and why it must be considered first when searching for interest rate sensitive markets. Whether something is affordable for somebody to buy is one of the main drivers and purchasing factors for them. And this is in relation to anything people buy in life, but especially when people are buying property, because it's one of the biggest outlays of money most people will make in this country in their entire life. Why affordability matters. Price booms happen when local incomes can comfortably absorb mortgage costs. So, a drop in interest rates can temporarily create a window where affordability improves even more, potentially accelerating price growth in specific markets that have the fundamentals to support that growth. This means that understanding changes in affordability can provide insights for timing entry into specific markets. And if timed right, means you can capitalize on early returns in totality before those markets heat up. To give some more context, affordability mainly impacts the owner-occupier market. Now, it does impact investors too, but we must consider the largest purchasing cohort in the market is the owner-occupier. Over the past year, the general price point that has seen the largest growth is the 700K bracket. The biggest cohort in that benchmark is the owner-occupier cohort. Again, one more thing that places affordability at the very start of this analysis process. And as we all know, it's the owner-occupier segment that pushes prices upwards. Calculating affordability. In order to work out how affordable a property market is, you need to consider the years to own, or Y2O measure of property affordability. Now, this metric is important as it provides an estimate of the time it would take for a property to be fully owned based on socioeconomics of an area. Calculating the Y2O is based on a standard 30-year mortgage loan with 80/20 LVR at current interest rates. This metric assumes that households contribute 50% of their median family income to mortgage repayments. A typical green zone, or a good place to be after calculating this metric, is 25 to 35 years, meaning it's neither too easy nor too difficult to purchase in that suburb or market. If the year to own metric is too high, example 40 years, it signals that particular property market may be becoming unaffordable. If the year to own metric is too low, example 25 years, the market might be undervalued, or it could be primed for a surge in demand. But just be careful that if you find a low year to own market, that it doesn't have certain disadvantages attached to it, such as really low socioeconomic issues that could dampen the potential for prolonged above average growth. Now, I am going to show you a few extra variable metrics to be aware of when using this formula in just a minute, but we need to run through this next part first. So most markets that you find where the affordability is in the green zone for the owner-occupier cohort should experience the most dramatic impacts from interest rate changes. That is because when you have a purchasing power that is already substantiated by high incomes within a particular suburb in combination with lower typical values in affordability terms, then if affordability in general increases further, we usually see some substantial increases in price in those areas. Now, there is always a lag in an area that has had improving affordability compared to it becoming less affordable again, because there is a lag in people purchasing property. For example, when the interest rate drops, you will be provided with a small window of improving affordability. And if people start to pile into that area, well, then prices will grow and therefore unaffordability will rise. That's why we want to capitalize on that small window of opportunity as early as possible. By knowing this means we get to time the market entry. Now, you've probably heard the phrase, time in the market beats timing the market. While this is somewhat true for long-term property holds, interest rate sensitivity shows us that when you buy can drastically affect short-term results. Now, if you enter a market just as interest rates begin on a downward cycle, you might see rapid capital growth in just a few years. But if you wait until rates bottom out and start climbing again, you might buy into a market at its peak affordability, only to watch it flatten or dip later on. So it's very important to be as accurate as possible when performing your analysis on affordability to ensure you nail the timing when you enter into specific markets. Metrics to note that will vary the years to own. There are a number of key metrics that can amplify or vary the years to own index result that you need to understand. Interest rate sensitivity. Now, a 0.5% or 25 basis point change in the cash rate can alter the years to own by about 0.58 years for houses, and a 1% interest rate drop can alter it by about 2.32 years. Higher typical price. Higher priced markets are often more sensitive to interest rate movements. Why? Because a 1% reduction in interest rates can unlock thousands of dollars in annual savings on large mortgages. Unit to house ratio. Areas with more units than houses often experience stronger purchasing shifts because renters in units can suddenly afford to switch into home ownership in houses. Remembering, this is in certain areas only, but does make a lot of sense. Socioeconomic index and school ranks. Higher socioeconomic areas are generally wealthier and often have schools that are more preferable. Now, buyers have stronger willingness and ability to purchase in these areas and tend to move quickly to buy when interest rates lower. While on this topic, note that some markets at much higher price points with higher socioeconomics and disposable incomes can tolerate a higher years to own. But this is outside the scope of this video because you probably shouldn't be making that decision yourself if you are learning years to own for the first time by watching this video. Distance to CBD. Historic data also shows the closer to the city centre, the more responsive a market is to rate changes, especially in capital cities. Now remember, just because you may have found a market that is primed for a surge in affordability doesn't mean this alone will push prices upwards. Which brings us to our next topic, supply scarcity. While affordability shapes how many people want to buy a property that have the means to actually do it, supply scarcity determines how many properties are actually available for them to purchase. Even if interest rates make borrowing cheaper, if there's an abundance abundance of housing stock, prices might not spike as dramatically. When supply is extremely tight, a small uptick in demand, such as that triggered by low interest rates, can lead to significant jumps in property prices. Investors love this scenario. If you're positioned in a suburb with affordability and limited stock, you can benefit from that quick price acceleration once borrowing costs drop. We have a video exclusively on calculating supply and demand availability in specific suburbs and markets, so check that out, and I've just popped a link down in the description. Let's do a quick hypothetical example. Suburb X is close to the CBD, has a median property price of $700K, an affordability index of about 32 years to own, and a strong downward trend in available listings. If interest rates drop by 1%, that could reduce monthly mortgage costs by hundreds of dollars, boosting affordability significantly. The result? A wave of buyers who were previously priced out might jump in. Because supply is tight, we see multiple offers driving prices up 10% or more within a year. That's the power of interest rates interacting with local conditions. But remember, on the flip side, if rates go up, the same feedback loop can happen in reverse. Over time, putting downward pressure on prices, especially in markets that had already become unaffordable. Most central banks have operated in a roughly 4-year interest rate cycle since the late 2000s. This can suggest that if you do buy in a rate-sensitive market, you should consider your exit strategy, especially if you anticipate higher rates a few years down the line. You'd want to possibly plan your exit prior to rates increasing. All right, let's say you decide to use interest rate changes to your advantage. Remember these 5 steps we have gone through today. Number 1, monitor central bank announcements and keep an eye on the Reserve Bank statements. Now, look for signals of upcoming rate cuts or hikes. Number 2, analyze suburbs by affordability. Use a years to own or similar affordability metrics to find markets that are already in a comfortable range. Number 3, check supply constraints, review inventories, stock on the market, building approvals, and hold periods. If supply is trending down, that's a green flag for growth potential once rates drop. 4, assess local socioeconomics, such as schools. Number 5, plan an exit strategy. If you expect rates to rise in 3 to 4 years, make sure you have a plan. Perhaps you'll even refinance or sell to lock in gains before the next rate cycle. Now, this was a lot to take in. So if you had any questions, give us a call. Boyd and I spend time with everyone who calls, and if you want to take advantage of buying into an area that is sensitive to interest rates, well, we know where many of them are. We can have a chat with you about that too. Until next time, happy property navigating.